and welcome to Alternative Thinking with me, Melissa Griffiths.
And me, Steve Dobson.
This is the podcast that takes a deeper dive into the alternative marketplace and topical issues.
But if we talk about sort of a balanced portfolio, broadly that would be around 50% equity and then 50% other things. Of those alternatives, which obviously everyone has slightly different definitions of what is an alternative, would be about 20%, and then the rest of it would be things like fixed interest and cash.
So that's the same place that a lot of these founders are in, is that there's a gap. The gap can be filled by EIS and VCT and angels.
Can also be seen and should be seen as an element of private market allocation into your portfolio. And I think that's quite important.
The allocation decision of savers is not just about their returns, but it's about the cost of capital environment for your domestic economy. And that's where I think there's been a policy mistake over many, many decades in the UK that needs correcting.
From my perspective, I think you're perfectly right about the patient capital review, because that has pivoted VCTs and EISs from MBOs and solar panels and other structures which were creating dividends themselves to cover the VCT dividend into venture capital. And venture capital trusts do venture capital.
Yes.
Kind of makes sense,
Yeah.
But before that period there was diversity in the asset class, and then there was some kind of lower risk approach to investing. But now it is all high risk and it's all potentially high return and well managed, and it will take time for VC to actually, within a venture capital trust, to develop. Maybe it is the 8-year hold period, maybe even 10, maybe even 15, but that can be facilitated within this semi-liquid structure.
But I think one of the beauties of a VCT is that they're evergreen vehicles. They are patient capital vehicles. So they're not structured in such a way that even if you have gone through a kind of bumpy period, the managers are kind of pushing to exit these companies at depressed or lower valuations. So I think in general, most VCT managers have therefore tried to reduce burn, reduce the amount of OPEX investment that some of these companies are making, so that they can actually sustain themselves. So they have sufficient cash to run their businesses and actually be companies in the future.
We had a world that was becoming more financially liberal. Old foes were able to transact.
Yeah.
You had a huge peace dividend, which still existed, certainly through the 90s, but even a little bit in the early 2000s relative to now. Those three pillars have unwound.
The European Commission about 6 years ago did a big study on schemes of this kind across the world, and they actually found that the number one most effective scheme of this kind in the entire world was the SEIS, and the number two most effective was the EIS. So we are really lucky in the UK to have the two leading schemes in the world in terms of investing in this area.
To hear more, please like and subscribe to Alternative Thinking from Growth Invest on YouTube, Spotify, and wherever you get your podcasts. This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high risk investments, and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money.